So, you've got some cash in your hands. Maybe you've been saving up, or perhaps you just received a windfall. Maybe it's from a birthday, a gift from a relative, or a reward for good grades. Or maybe you've been resourceful and are selling your sport collection online, turning your quirky hobbies into cold hard cash. And now you want to invest it to make that money work for you and grow over time. But where do you even begin? Where should you put your money to get the best return? Enter the payback period, a simple yet powerful tool to help you evaluate potential investments. It simply asks the fundamental question: how long will it take until I get my initial money back from this investment? Imagine you and your friends decide to start a lemonade stand together, a classic entrepreneurial venture. You're investing $100 to buy lemons, sugar, cups, and a fancy sign. The payback period, in this case, is how long it takes, in weeks or even days, to earn that initial $100 investment back through lemonade sales, from all those refreshing lemonade sales. Once you hit that payback mark, everything else you earn is pure sweet profit. Companies use this same principle too, whether they're considering building new factories or launching innovative new products into the market. A project that pays for itself, say, in 2 years, is generally considered less risky and more attractive than a project that takes a long 10 years to recoup the initial investment. The payback period, therefore, is all about speed and efficiency, how fast you can recover your hard-earned initial investment. It's a quick and easy gut check, a first-pass filter for evaluating any potential investment opportunity, helping you quickly decide if it's likely to be a fast win and a quick return, or a long and potentially risky wait. Calculating the payback period is easy. Just divide the cost of investment by the average annual cash flow. For example, if solar panels cost $1,000 and save you $1,200 a year, the payback period is $6,000 with 5 years. For a business, if a machine costs $200,000 and saves $50,000 a year, the payback period is 4 years. After the payback period, all savings or profits are extra. This simple math helps you see how long your money will be tied up. It's a tool anyone can use, no finance degree required. Just plug in your numbers and see how quickly you'll break even. That's your get your money back date. The payback period is great, offering a quick snapshot of potential profitability. It's particularly useful for quick decisions when you need an immediate assessment. It's also helpful for managing risk, giving you a sense of how quickly you can recoup your initial investment. This is especially valuable if you need your money back fast, providing a safety net in uncertain markets. But here's the catch. There are some significant limitations to keep in mind. First and foremost, it ignores the time value of money, a critical factor in financial analysis. Simply put, $1 today is worth more than $1 years from now, due to inflation and potential investment opportunities. It also completely ignores what happens after you break even, focusing solely on the initial recovery period. For example, consider this: a project that pays back in 2 years, offering a seemingly quick return on investment, but earns absolutely nothing after that initial period, providing no further value. That project isn't nearly as good as one that takes 4 years to pay back, but keeps earning significant profits for decades, generating substantial long-term wealth. Therefore, focusing only on speed and immediate payback can make you miss out on bigger, far more lucrative, long-term gains and opportunities. The payback period is a blunt tool, a very basic measure of financial viability. It's good for a first look, providing a quick initial assessment, but it certainly doesn't tell the whole story and shouldn't be relied upon exclusively. Use it to screen ideas, quickly filtering out obviously unviable projects, but don't rely on it alone for making critical investment decisions. Smart decisions need a broader, more comprehensive view of the financial landscape. So what else should you consider when evaluating potential investments? It's not just about the initial cost or the immediate return. Tools like discounted payback period, which factors in the time value of money, net present value or NPV, a cornerstone of investment analysis, and internal rate of return or IRR, each offering a unique perspective, give a fuller, more comprehensive picture of an investment's potential. NPV adds up all future cash flows, discounting them back in today's dollars, giving you a sense of the investment's true worth. IRR shows your investment's true rate of return, taking into account the initial investment and all subsequent cash flows. These help you see long-term value, providing insights beyond immediate gains, not just speed. Still, the payback period is useful, especially for quick checks, a fast way to gauge risk and potential reward, like deciding if a new printer or other small capital expenditure is worth it. Use it as a filter to quickly eliminate less promising options, then dig deeper with NPV or IRR for a more nuanced understanding for bigger decisions. Smart investing means using the right tool for the job and understanding its limitations, and asking, how fast do I get my money back? A crucial question for managing risk and how much will I make overall, considering both short-term and long-term gains. That's how you build your financial future, by making informed decisions, one smart step at a time.